Well, on this Halloween Sunday, we've got to chat a little bit about the proposals that came down from the Mount Washington, D.C. this past week. Are there some tricks in there? Are there some treats? Well, we're going to hit some of the highs and lows of the framework that was announced by President Biden on Thursday, along with some of the misguided perceptions that many folks have about retirement. All that and much, much more here on the program. Welcome, of course, to Dollars and Cents. As our good friend Bud Hedinger aptly says in the introduction, we're Central Florida's longest running radio program, coming to you on a variety of networks throughout the Central Florida region. My name is Joel Garris. I'm a certified financial planner and certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. Speaking of that team, we were happy to have Rob Field on the program last week, talking a little bit about the Social Security changes, the big 5.9% cost of living, that inflationary increase. And understand that we had a couple of points about that as well. And so the first thing that you have to realize is that, yes, it is a large number. 5.9% increase seems like a lot, but remember the conclusion that we came to on the program last week, and that is that it's not really extra money. An inflationary increase, a COLA increase, a cost of living adjustment simply means that the cost of living has gone up and you need more money to buy the same stuff. So that's the thing about inflation that should get everybody's attention, is that, okay, great, it's more money, but it doesn't actually help me. It just helps me stay even. It doesn't help me get ahead. And particularly, we were making the comments about seniors being disproportionately affected by the impact of inflation, because the cost of living adjustment for Social Security is based upon inflation for society as a whole. Well, seniors have a different rate of inflation, and this is the stat that we uncovered this past week that we want to kind of share with you to help really crystallize that commentary, because seniors do have a higher rate of inflation simply because one of the biggest things that they consume when you are in your 70s and 80s and whatnot is healthcare. And we all know that the costs of healthcare have been rising at a much greater fashion than pretty much anything else in society, with maybe the exception of college, which is a whole nother radio program and commentary. But the reality is that seniors certainly have a much higher rate of inflation. How much? Well, here's the punchline, if you will. We saw this statistic. So here are some hard numbers on kind of that concept that we were talking about last week that we wanted to share with you on the program this week. So since 2000, so that's 20 odd years, Social Security benefits have risen a total of 55%. So that seems like a lot, but if you think of that over 20 years, that's probably, what is that, like 2%? Maybe a little bit more than that on average over that entire time period. The reality is that when you look at typical senior expenses over that same time period, they grew by nearly 102%. So you clearly have a gap, and that's a significant gap that I think really bears some discussion. And here we have this past week rolling out this big framework, 1.8 trillion, 3 trillion, whatever the number is. What's interesting is what it doesn't speak to. We talked a little bit about this on the program. Does it speak to shoring up Social Security? No, not really. Does it speak to adjusting the cost of living to catch seniors back up? No, not really. It's got a bunch of stuff in there that we'll certainly talk about in the next segment, but just really it was a statistic that we saw this past week that we wanted to share with you this week because it really sort of highlights the conversation that we were having with our fellow certified financial fiduciary at Nelson Financial Planning, Rob Field, on the program last week, is just this gap, if you will, in terms of how behind seniors are in terms of being able to stay up with inflation. 5.9 is nice, but yeah, you're just treading water on it. You're not actually getting ahead. Speaking of seniors, though, there was another statistic that we saw this past week that also troubles us a little bit, and maybe even more. Well, no, probably not more than the cost of living, because that's a real issue. This issue, though, speaks to what seniors find themselves getting stuck with. And that is, statistically, the second quarter of this year saw a huge increase, a huge boom in annuity sales. Isn't that great? Man, a boom in annuity sales for seniors is just dynamite, right? I mean, you talk about it getting hard enough to stay equal with inflation, and along comes the relatively unregulated insurance industry to push product based upon false promises, high commissions, high expense. What a great deal seniors are getting in society today. And basically a highly unregulated market. Stop and think about some of the claims that you hear with these annuity stuff, right? You get all the market upside with none of the downside risk. That's the spiel, right? You get all the market upside, none of the downside. Folks, if you've been told that is about as real as the leprechaun sitting on the pot of gold at the end of the rainbow. It doesn't work that way. Don't suspend common sense and get into an investment product that requires you to suspend common sense. Here's what we mean by that, right? So stop and think about that. First of all, an annuity is a product issued by an insurance company, right? So the insurance company is not doing it out of altruistic reasons, right? I mean, they've got to make money. So, well, if they're saying we're going to give you the ability to get all the upside of the market and you never have to worry about when the market goes down, stop and think about that. How is that even possible? How is that concept even possible, right? Because you've got an insurance company, the insurance company doesn't have a crystal ball. Nobody has a crystal ball. They're not be able to tell the future. So how do they do that? And here's where, if you ever look at the prospectus on these things, it's like that. Well, if you're watching us on YouTube, our YouTube channel, you can see it's like it's a thick document that's filled with a lot of fine print. And the reality is that they do it through caps, they do it through things like participation rates. And of course, my personal favorite is they strip out the dividends from the performance of the market. Well, if you look at the history of the market over the past 88 years, what you will find, or 80 odd years, is that dividends account for nearly 44% of the performance of the market. So if you strip that out, you start putting in caps, participation rates, things like that, guess what? You are getting something that isn't even close to what it's been described. But here are the numbers, sadly. Second quarter of 2021, total annuity sales up 39% from the prior year. Variable annuities up 55%. So the variable annuity piece was even higher. Folks, just put your money in a mutual fund and don't pay the extra 2 or 3% that comes with an annuity. Fixed annuities up 27% year-over-year sales. My personal favorite, indexed annuities, which are these nonsense things. You can get all the upside of the market, none of the downside risk, up 28%. Folks, stay away from these high commission, too good to be true sounding investment products. We're going to take a break. We'll return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Okay, so if we didn't get a little fired up in that last segment talking about how seniors are getting the short end of the stick when it comes to inflation, remember the statistic that we found this past week. Past 20 odd years, Social Security benefits have increased by 55% through the COLA adjustment. Problem is that if you're a senior, you've seen your costs of expenses go up by over 102%. That is a shortfall, and that's a shortfall that's not getting discussed despite all of the conversation out in Washington. That, along with the high cost, high commission annuity product stuff that goes on. We're going to take a breath, but unfortunately, this segment, we're going to have to talk about Washington. So we'll probably amp it back up again. Proposal coming out on this past Thursday, the framework, if you will. So who knows whether anything that we say in this segment of the program will actually happen, because it is just that, a framework, a proposal. But I think it's important to have the conversation, because it seems to be at least giving an indication of what is going to be acceptable in Washington versus what is not. A little trick and treat, if you will, here on Halloween Sunday that we'll have to spend some time talking about. So here's the good news, and I guess relative in terms, right? Because if you look at the plethora of just an unbelievable litany of horrific tax proposals that were on the table, is it really good news when some of them go away and you're still left with a few of them? I don't know, but the reality is that's where we are at. So a couple weeks ago, we were joined by fellow certified financial fiduciary, also CPA, member of the team at Nelson Financial Planning, Kristen Cayley, and we talked about some of that broader range of tax proposals on there. I think coming up maybe next week or the week after, we're going to have another one of our team members at Nelson Financial Planning, Christina Lamb, on. She is a IRS enrolled agent, and so she probably will be on to kind of talk about some of the details of what some of these current proposals really have to talk about. But here's the latest, and I guess in terms of the proposals that came out, a $1.85 trillion kind of framework or game plan, if you will. I think it's important first to start this conversation about what was eliminated, because it seemed like over the past 30 days, there was so much stuff that was just kind of floated out there, and to just almost test the waters, if you will. And so some of the things that failed to carry any water, that were clearly in sort of the trick bag of things, involved the ability to look at bank accounts involving transactions above $600, right? There was this proposal that was going to allow the government to really kind of look at the ins and outs of your bank accounts, and then that was started at 600, then it was floated up to maybe 10,000. That did not make its way into the framework, and obviously I think that's a pretty good thing, because I don't know that I want my government knowing everything that's going on involving my checkbook. So that one kind of died, or at least for now, died on the vine. Another one that sort of died on the vine is the notion of eliminating the step up in basis. Now, this one was widely talked about, and what it has to deal with is if someone passes away, right? So let's say they bought a stock and they put $10,000 into it, and they never really sold the stock. They just owned it. They just held it. They were a long-term investor. And so that $10,000 grew to $100,000. Well, that's an embedded $90,000 capital gain. When you pass, that gain in its entirety disappears through the concept called step up in basis, which jumps the value for tax purposes up to that value at the time of death. So that would be back up, right up to the 100,000. So what that means is that you had $90,000 of gain that was never taxed. So you see kind of the issue there is, well, wait a minute, you had appreciation, you made money, and that wound up being avoiding tax, because when you died, there's that step up in basis. So there was a lot of conversation about that, where they started it out at any level, then they increased to $1 million, and then they said, well, only if you're super wealthy. And then some of the other proposals that were out there that talked about, well, if you've got assets that have appreciated, like take that example of I put 10,000 in to a particular stock or fund or whatever the case may be, it's worth 100,000. Well, we're going to tax that appreciation along the way, even though you did not sell anything. We're just going to continue to tax that appreciation as it happens. Again, all of these concepts in particular, the step up in basis and in embedded capital gains, things like that, those concepts really have been pretty solid concepts in the tax code for about a century. And so I think at the end of the day, that's why those all sort of fell off, if you will. Similarly, we didn't see any estate tax exemption adjustments, or at least, again, in the framework as it exists today. I think that's interesting that we didn't see that because I would have thought that that might have been something that they worked with. The reality is that the estate tax exemption in America today is north of $11 million per person. When I started out in this business, it was like $600,000. I mean, it has gone up so much, and that's good, but it seems to me that it's kind of the thing that might be ripe for an adjustment in order to raise revenue, because all of this stuff is supposed to be paid for, or fully paid for, as they like to advertise, through the tax increase side of it. We're going to get to that here in just a little bit, but the reality is that the notion of the estate tax exemption, I think a lot of people didn't bother to really embrace that or touch that because no one wants to be responsible for increasing taxes. I mean, that's the game that they're all playing. It doesn't matter whether you're Democrat or Republican. You don't want to be painted in, oh, you raised taxes. So the thing about the estate tax exemption, I think people sort of forget, is that those higher levels of estate tax exemption are in fact set to sunset or expire in a few years anyway. So if they don't do anything, it'll eventually come back down to a much lower amount in terms of that estate tax exemption. So those are some of the things that were not in the soup, if you will, based upon the framework that was announced this past week. Here is what is in the soup, if you will. And as you might well imagine, it has a lot to do with some of the priorities that the Biden administration has certainly talked about over the course of the past year. And that involves expanded subsidies for healthcare under the Affordable Care Act. So if you wind up getting insurance on the exchange, then your eligibility for a subsidy towards that premium is going to go up or become more available. Remember, if you're getting insurance on the exchange, that's how that works, is you wind up getting an advanced tax credit. Heaven forbid, though, if you go have a better year than what you were expecting and you go above those thresholds, because the recapture on that then means that you may have to pay all of those credits back. And we've seen those play out on tax returns that could easily be $13,000 or $14,000. So be careful if you're playing that game. They are going to expand it. That's one of the areas in which they are planning on doing that. Medicare expansion, again, God love them. You're expanding Medicare. Last I checked, the shortfall in Medicare, Medicaid was actually 7 times greater than the shortfall in Social Security. But hey, here we are. We're going to expand Medicare to include hearing. Again, nothing wrong with providing that benefit, but how in the good world are we going to pay for it? That's the issue that I think nobody's really kind of wrestling with. There was some talk about including dental and vision in that expansion of Medicare. Unfortunately, for seniors, that did drop itself out. It does appear that they're focusing more on the hearing. Of course, climate change, big topic of conversation for the current administration. You see a variety of proposals. This piece is actually like the biggest piece of the whole framework. A variety of tax credits to change personal and corporate behavior, tax credit for cars, solar panels, things like that. It is what it is. I have certainly seen in the time that I've been doing this a lot of tax credits that have come and gone, and I don't know that tax credits necessarily permanently change behavior, whether it's on an individual basis or a corporate basis. But anyway, that's the part that's in there. We've got a lot more to talk about in terms of the framework. So we come back, we're going to continue the conversation on the framework coming out of Washington this past week on Dollars and Cents. Talking about the tricks and the treats in the proposal that came out of Washington this past week, and most importantly, how it relates to your money. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars and maybe even maybe make sense out of what they're doing in Washington. I don't know. That's probably a really pie in the sky kind of goal. Anyway, my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So in the last break, we were talking a little bit about some of the framework, more particularly focused on what was not in it, started to kind of get to what was in it. And next up on sort of the list of what was in the framework, if you will, is this notion of a fully funding pre-K for 3 and 4 year olds. And obviously, that's great. That's a great thing to be able to do. Sometimes I wonder if maybe we shouldn't be throwing more money at our high schools, particularly when it comes to teaching things like, I don't know, baseline finances, like how to balance a checkbook, or maybe even why you should be using a checkbook rather than just relying on that online app on your phone, or maybe, putting a little bit more into vocational or clearly activities that you may need to have during the course of the rest of your life. Anyway, I digress. Speaking of that, though, one of the pieces that was attempted or thought to maybe be in some of these tax changes coming out of Washington is this notion of tuition-free community college. That did not make it in. Similarly, the paid family leave part also did not make it in. What did make it in, though, was an extended child tax credit for 2022. That's something that was introduced in the COVID legislation that passed earlier this year, where you saw big jumps in the child tax credits. Those increases are going to be continued on over into next year, or at least based upon the framework. Again, as we said in the beginning of the last segment, this stuff may all change this week, and if it does, then we'll keep you informed next week on the program. The reality is that a lot of this is in the proposal form. Speaking of politics and how all this plays out, got a very interesting gubernatorial election on Tuesday out of Virginia. A lot of folks are looking at that and seeing, okay, well, if the Republicans somehow manage to win, then that may throw a lot of sand into a lot of these proposals. So much to look forward to in terms of the week ahead and how it might impact all of these proposals. So that's what's in it in terms of, I guess, the tricks or the treats. No, I guess that's the treats. That's the treats part, right? Now here come the tricks, right? So okay, well, how do you raise the money for all of this? And obviously that comes in the form of taxes. So what does that look like? Well, it looks like a minimum tax of 15% on corporations. Also a 1% excise tax on corporate stock buybacks. You always question kind of how much some of these proposals will actually raise in terms of revenue. Remember, a corporate stock buyback happens when a corporation says, oh, I've got this cash and it's just sitting there, not making any money, because cash isn't making any money anyway in today's environment. And so what do I do with it? And maybe from an investment perspective, rather than sit on an obscene amount of cash, corporation decides we're just going to buy back some of our stock. And when that happens, that ultimately drives up the value of the remaining shares of stock, because obviously if you've got less of something, then its value winds up going up more over time. So the notion of what companies do in terms of that cash, that's where this sort of excise tax of 1% would come into play, where corporations would have to pay that if they use their money to generate or to do a stock buyback. I think there's a lot of ways as a business to just kind of sit and not do that, or maybe not do the stock buyback. But anyway, that's part of it. Individuals, and again, this is one of those things where I don't know that a lot of society really, I guess, cares or feels strongly opposed to these types of tax changes. But because when you hear it, you say, well, who the heck is that? That's nobody that I know. Here are the numbers. It's a 5% surtax on incomes above 10 million. And then if your income is above 25 million, again, I mean, who is this, right? I mean, if your income is above 25 million, then there's an extra 3% surtax on top of that. So then above 25 million, then you'd be paying 8, not 5. So those are the proposals that are in there in terms of generating out the tax revenue side of things. I think it just goes to what's the highest marginal rate in society. And then this notion of, we're going to take from those that are generating out income and redistribute. Sometimes I kind of worry about how far down the path we go. And if you've ever read Atlas Shrugged, then you know how that plays out. Anyway, but that's the proposals that are on the table. Similarly, if you are a business owner, regardless of income, so this piece doesn't apply whether to you making 10 million or 25 million. This applies to business owners in terms of the pass-through, like S corporation profit, which avoids the 3.8% extra tax. They would then apply that 3.8% tax to that profit. So and then and this is the one that just kind of bugs me more than anything, because I think it's a philosophical statement on Americans. They're going to double the size of the IRS to increase enforcement, and that's going to bring in more money, because after all, America is filled with a bunch of liars and cheats. I don't know that I agree with that. Doubling the size of the IRS is only going to create more headaches for taxpayers in terms of trying to deal with their taxes. We've certainly been through, particularly this year, a lot of letters that came from the IRS that simply changed the tax calculation in light of what the IRS said that you got for your stimulus checks. Not really any good way to argue it, because how do you prove that you didn't get something that the IRS says that you did? And so many folks were just forced into accepting those letters. That concerns me on a lot of different levels, as I am sure it does you. Anyway, that's the latest and greatest out of the good folks in Washington. Little tricks, little treats, a perfect topic for a Halloween Sunday financial planning radio program, right? Speaking of financial planning and our website at Nelson Financial Planning, we do blog posts, as you know, on a regular basis. And so we're going to include one of the blog posts. Actually, I think we're going online with it today, as a matter of fact. So if you're interested in checking out the blog posts on our website at Nelson Financial Planning, it's how to become more valuable. Interesting. How do you become more valuable? And in the article, we talk about the connection, if you will, the relationship that individuals should have in terms of thinking about their personal finances versus how a business or a corporation does it. And the two chief documents that we encourage people to think about to become more valuable is this notion of utilizing a balance sheet, utilizing an income statement, which are the two standard financial documents that any business uses. The balance sheet gives you a snapshot on your assets versus your liabilities. Income statement, money in, money out, income versus expenses. Both of those are great tools to use. Look at the asset side. See if you've got enough in an emergency savings fund. See if you can pay off short-term liabilities. That's a good way to make yourself more valuable if you're able to do that. If you're looking at the income statement, the profit and loss statement, what if I pay myself first? Isn't that a great way to help increase my savings for retirement? So those are some of the concepts in our latest blog post. So make sure you check that out on our website at Nelson Financial Planning. We're going to take a break. When we return, we're going to talk about some of the common misconceptions that retirees have here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Thinking about Halloween, obviously happy Halloween. Hopefully your day is filled with more treats than tricks. Last night, watched The Shining, which if you haven't seen that one in a while, it is still as disturbing as it was. So, but a good classic film, particularly during this time of year. Also was, of course, thinking about some of the common misconceptions, because after all, we do have to, kind of prepare for a radio program, and you don't want me sitting here talking about movies. Instead, you want me sitting here talking about finances. So we're thinking about some of the common misguided perceptions that people have when they are going into retirement. So welcome, of course, to Dollars and Cents, Central Florida's longest running radio program, coming to you on a variety of networks throughout Central Florida, along with our podcast, which also happens to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your podcast channel of choice, whether that's Amazon Music, Spotify, iTunes, whatever the case may be. We are there. If you have trouble finding our channel, just go to our website at Nelson Financial Planning. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar and you'll get immediately connected over, along with, of course, the option on YouTube as well, where you get to see a video of this program in that format. So anyway, this is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team stands ready to help you this week change your life with a successful and cost-effective financial plan, or maybe change your mind about some of the misguided perceptions about retirement, one of the biggest of which is the length of retirement. We often have people in their early 60s saying, oh, well, I don't have many years in front. And the reality is that for a couple, age 65 in America today, there's nearly a 100% chance that one of that couple, or at least one of that couple, will be around at the age of 85. That means when you're 65, you still have about a quarter of life in front of you, and that's the retirement that's going to last a while. Certainly need to address inflation, need to address taxes along the way, combined with, of course, the fact of those healthcare costs which creep in there. It's estimated that those will be about $300,000 during the course of a retirement. Toss in facility care if you need to have that. You get the picture. It's not the end of the rainbow, if you will. It is simply the beginning of the next chapter of life that you need to make sure is funded, and funded as fully as it can be. So that's the big part about one of those misconceptions, is that people think it is not going to be that long in terms of the length of your lifetime, quarter, maybe even a third, depending on how fortunate you are on your longevity. So definitely a number of years in which that needs to be covered. And the problem is, of course, as we know, along the way, things can happen. Unfortunately, nearly half, 44% of Americans dipped into their retirement funds early. That means you're paying taxes early. That means that if you're under 59 and a half, you paid a penalty. And most importantly, if that wasn't enough between taxes and a penalty, you lose out on the opportunity cost, the future growth of those funds. So it may not seem like much, but if you're grabbing $5,000 at age 40, that has the ability to be the equivalent of $40,000 at age 65, assuming kind of a normal rate of return over that 25-year period of time. There's definitely an opportunity cost that you give up even on the smallest amount of those distributions, or those early dips, if you will, into retirement. Savings numbers are rough. We certainly hear the stories about that in terms of the average savings. Median savings for that age group, age 55 to 64, is a little over $100,000. To put it into perspective, on $100,000, that has the ability to generate out about $400 a month or so. I mean, that's not much in terms of being able to cover expenses and things like that. So be aware of what those numbers are. To compound it all, then you wind up having an issue with Social Security in terms of the current format, what it looks like in the year 2035. The number of Americans 65 and older in the year 2035 increases from 56 million to 78 million. So you got a lot of folks that will be taking Social Security and aging. And then, 50% of Americans retire before they really wanted to for a variety of reasons. Maybe it's a job shift, a pandemic, whatever the case may be, a health shift, or maybe you've got now responsibility for giving care to a loved one. And so all of those all kind of go into the mix that can change your perspective of retirement and what that is going to look like. So what are the ways in which to deal with that, right? This is all that what we've just talked about is all just kind of life stuff, if you will. But what are some of the things that you can do now to help put yourself in better shape so you don't get caught up into some of these preconceptions about retirement? Well, it starts with having your own retirement plan. A lot of employers don't offer a retirement plan these days. So certainly some evidence that says that less are because of just the cost associated with having to maintain those plans. So as less offer, then it's up to you to be able to go out and find your own retirement plan. But that's super easy, right? You can set up an IRA, an individual retirement account, at any point in time without really any issue whatsoever. And then you can fund that using something called a systematic investment plan, where you're putting money in on a regular basis, and that way you're funding that retirement just like you normally would if you had a retirement plan through your employer. So make it automatic. Pay yourself first. Again, we mentioned that concept in the last segment as it related to our blog post about how you become more valuable. The reality is that pay yourself first, and then that way that money is coming out automatically going into funding a retirement account. Number two, make sure you're prepared for changes, right? Have different baskets that you can access at different points in time. This is where having an emergency savings account comes into play. Having an account that you can utilize that isn't going to be restricted like a retirement account, right? There are types of investment accounts that you can set up that are after-tax investment accounts, which means that you can utilize that money at any point in time without a restriction or without a big tax consequence. So make sure you have that good mix of investments that allows you to be able to access certain parts without big tax implications. And then along those same lines, important to have an emergency savings account, right? That's an account that's just cash. Maybe it's not making anything today. I understand that because of where interest rates are, but the reality is that those accounts are accessible and available no matter what. And as a cash account, then there's not going to be subject to any fluctuation. So important to kind of have that emergency savings account to get around these things that can happen along the way. And then lastly, always a good idea, try and reduce debt, particularly if it is of a short-term nature. So that would be like credit card debt, where the interest rate is very, very high. So those are some of the things you can do to kind of manage around some of these preconceptions about retirement that ultimately are a little different for people. So anyway, we're going to wrap it on up and get on out of here. Have a safe and enjoyable Halloween out there. Looks like it's going to be a beautiful day here in Central Florida, so enjoy that. Thanks for listening to the program. This has been Dollars and Cents with your host Joel Garris of Nelson Financial Planning.